Hey guys, Toby Mathis here with Anderson Business Advisors, and today we're going to talk about the best tax software out there. So let's dive right on in. All right, so let's talk about tax software first off. Usually we're talking about tax prep software. So somebody's going to be using Altera or CCH. Some people use Lacert, some of the smaller firms. But if you're a big one, you're probably using CCH or Altera. Our firm uses CCH. I think it's the derivative. I think Pro Systems is what it is on the desktop, and then you're looking at Access if you're going online. And that is what the big four are going to be using. That's what most of the larger CPA firms are using. Now, I'm just going to say this. It's complex, and so it really comes down to the data that we're putting into it. So they're very, very robust systems, and I don't look at it and say which one is better, which one has the capacity to do your returns best and to make sure there's no errors. Because you've all heard of like a lot of the online software things that they'll have an error and they'll repeat it a million times before they figure it out. It's no different than what happened when the investment firms started reporting basis on options and things like that. They got it wrong and everybody had to go and amend returns. Their reissue was just a dumpster fire for that year. For any of those tax practitioners, you know what I'm talking about. You had to go through and amend a lot of returns because they had to issue out their documents against we're always getting 1098s, 1099s, stuff that you're putting on your Schedule D. Anyway, here's what I'm going to say about software. You're only as good as the data that you're inputting into it. So if you're doing projections and things like that, you have to make sure that you have accurate data. And they're very robust at being able to do things like see which way is better, A or B, so that you can give guidance to somebody. Quite often, you're putting together the return at the end of the year using last year as an example, but you might be putting stuff into the return to see what it will kick out, to see whether your taxes are going up, down, whether a change in a way of something is being depreciated, for example, is going to have a significant change. You're able to do that in these softwares. You're able to run side by side and do scenarios, but at the same token, your tax person can do that. That's a lot of times what I'm doing is I'm doing it just knowing here's what the rules are. Let's take a look. You could do this, you could do that. And it's not going to get you to the fine point, but it's going to get you into the right area. So we could say, hey, if we're going to accelerate depreciation, for example, I could say, hey, here's what your depreciation is. Here's how much income you have coming in off your rental properties. For example, if we're depreciating real estate in a residential property, we're looking at here, we got the 27 and a half year. You put the building into service on this date or the property into service on this date. And here's what our depreciable basis is. And if we accelerate, here's what it will do. Here's the year that was put in service. Here's the bonus depreciation available. And you can start doing, here's the different opportunities. You don't need software to do that. You can actually do that with a pen and paper and get a pretty good idea. The other thing that tax software does not do when you're talking about prep is your books, and you're only as good as the numbers that you're putting in, so it requires good books. And I do have a very strong opinion on bookkeeping. There's the big boy on the block is QuickBooks. Yes, there's others, but most major institutions are using QuickBooks. Like if you're going and you're working with people on a daily basis, which I do in the business realm, it's almost universal. Yes, there's a few one-offs, but I'm just going to say QuickBooks is the standard that pretty much everybody uses, but it's also a bazooka for a lot of companies. Now, when you're doing as a tax professional, you're going to have an enterprise edition where you can do returns for all your clients inside of your software. They don't have to go out and buy a bunch of software. You can actually maintain their books for them. There's that version, or what we prefer, which is the books are kept online with QuickBooks Online. And then we both can go in and take a look. And this is really, really, really important. Whenever you're looking at a tax situation. So if I have a client come in and everybody wants to talk about the future, everybody wants to talk about here's what I want to do, here's what I want to do. Sometimes you just have to hold them and say, hold on, let's look back. Let's see what you've been doing. Let's see if there's anything that we could change from the past that will net you some positive returns. Let's see if maybe there's an amendment in maybe somebody was accounting for something incorrectly. Maybe there was something dropped off. Like I can't even tell you how many times we've been doing returns for real estate investors and they're not writing off their insurance or their property taxes or something else that just kind of goes without saying. but because they didn't turn over those forms to their accountant didn't put it in, right? So your bookkeeping will solve that, but you have to look back. We look and say, here's the things that are important. Here's the stuff that we missed, or that somebody didn't put on, or here's a different way you could do this. By the way, hey, this is how you've been accounting for these things. We can make a change of accounting on a property, for example, and maybe we can net you some better results. So you always look back, then you look at exactly what your structure is right now. And that's where a lot of times we're sitting with an advisor and we're looking at an asset protection and a legacy plan, and we're seeing how everything kind of flows together. Quite often, for example, if you're a real estate investor and you're doing it in earnest, you're going to have a holding entity, and then you're going to have sub LLCs in different jurisdictions. There's returns required in most of those jurisdictions, wherever the source income is. You have to have software that can handle that, but also we need to account for it. It's going up. If you're using QuickBooks, we can create classes, so we don't have to have multiple sets of QuickBooks on that scenario. We could have 50 properties in one set of books, even though there's 50 different entities for asset protection. We don't have to make it to where each one is doing its own tax return, for example. If we're consolidating them all into a single partnership return, for example, like in a LLC that is a holding entity, let's say it's in Wyoming, and we have all of our other real estate LLCs pointing to it, we could do one single tax return for it, but we can also do one single set of books and then have classes on all the other LLCs. It just makes life so much easier, makes it so much cleaner, and then it can give you actually can look at one set of books and get a really good idea, as opposed to what a lot of accountants do is they'll have partnership. And I'm sure those of you who I'm speaking to that have 5 or 6 partnerships realize that each one of those comes with a separate tax bill, separate set of books, gets expensive. Like even what QuickBooks Online is $50 a month per company. So like I'd rather have one company that has 50 companies underneath it and be paying for one as opposed to 50 sets of books. Or you're going to be tempted to go ahead and try to do things on a desktop and you're remoting in and doing all that nonsense, and it's super clunky and you have to go out of one set of books and go back in another. Those of you who do bookkeeping know what I'm talking about. It gets very, very time consuming and clunky to do it where you have lots and lots of companies with separate sets of books. So you can consolidate. You're certainly allowed to do that and then use the different class system. You can do that with corporations too if you're using Q subs, for example, with S's. Or if you have subsidiaries, quite often you'll be able to put them under one set of books, do a consolidated return, voila, life is easy. But it comes to, we want to document the present. Then we want to look to the future. And when we look to the future and we're thinking about your tax plan, there's 2 really critical components that go simultaneous. Number 1 is your books and records. Advice is only as good as the information that you're receiving. And if the information that you're receiving is not accurate, you're going to get inaccurate advice. It may be pretty close, like, hey, I think this is what this cost is. Like if you're spitballing ideas, sometimes you can do that, but there's nothing that replaces good books on a quarterly basis. If you have good books on a quarterly basis, your accountant can very quickly see what your tax scenario is going to be and make sure that they're giving you the best advice looking forward. And that's why it's really important. And when you're looking forward, you're saying, here's what the trends are showing. Here's what we predict as being, like, here's your income for the year. Here's some things we could do at the end of the year. My clients get pretty used to me. I'm a big believer in you're doing your giving. And quite often we're writing that check in the last week of the year saying, hey, what's your tax? Hey, you can lower it to this much if you're willing to give some, or we're able to use your charitable giving or give away some capital assets. And we can say, here's what your adjusted gross income is. Here's how much appetite you have if you want to give away some crypto or some stocks or even some real estate, some appreciated assets, you can do that. But in order to do any of that, I have to actually know what your numbers are. And that's why the bookkeeping becomes so important. And what's so bizarre, guarantee you that almost all tax practitioners go backwards. They start looking in the future. Then they might back into, hey, we actually have to keep some books. Then they might kind of look at where you're at now, and they're really just looking at the future, and they're just kind of glancing at where we are now, and they never look back. Once they do a return, guarantee you, they almost always say, like, it's done. Well, wait a second. We sometimes want to take a look and see if there's anything else. Hey, how are we accounting for things? Did we find anything today that would have an impact on the previous returns? Is there anything that's going to benefit us? Now, when you do that, some people get scared and they say, oh my God, if they're looking back at my returns, what if they start changing them? You're not under an obligation to file amended returns. Even if you owed some more tax and something was done and you're like, oh my gosh, I can't believe it. Like, whoops. If you did it in good faith, there's not a legal obligation to go back in and make corrections. So that's just one of those things. When you're running your business, sometimes you say, here's what it was. Then you find out 2 years later, oh my gosh, the inventory was off by $1,000. That's not something that you sit there and worry about. But we still look back. We want to see whether there was any monies lying down or if the past is going to dictate some of the things in the future. So for example, if I am looking at somebody's return for this year, it's really helpful for me to see what they did the previous year and the year before that. And I could say, well, wait a second, we had an automobile on this business return. What happened to that automobile? Oh, I don't know. We still have it. Well, how come it's not on this year? It's not on last year, and then we should have it on this year. It allows us to catch those types of things. Or I wish I had a nickel every time somebody forgot about a property. So you're looking at a past return saying, well, it has this property, this property, this property, this property. Oh my gosh, I forgot about this. I've had that happen. You have so much stuff and you're like, again, you want to have really good books, but one mistake here will get repeated year after year. A lot of times people will the software will just keep carrying it forward. So it is helpful for you to make sure that you're looking back, looking at the current scenario, making sure your books are solid, and then doing our tax planning for this year and next year, trying to put things in place that maybe it's a 10-year plan. For those of you guys who do qualified opportunity zone funds, you know what I'm talking about. You might be doing a 10-year plan, but you're able to take a really good, hard look to say, what are the things that we should be doing right now that'll benefit us? Hey, if you like this type of information, please like this video and please subscribe to the channel. I know sometimes it gets deep, but this is the type of information that keeps you from making big mistakes that can have a dramatic negative impact on your business or missing out on things that would have a dramatic positive impact on your business.